Welcome back to Invest Insights Pro. In our last lesson, you built your emergency fund. Today we go one level deeper, because there is a dangerous myth in investing. The myth that diversification always protects you. In March 2020, millions of investors discovered the truth. This is the story of Deepa. Meet Deepa, a portfolio manager trainee from Hyderabad. Her portfolio looked like a textbook. 40% in equities, 20% in a gold ETF, 20% in corporate bond funds, and 20% in liquid funds. 4 assets, 4 directions. Perfectly diversified, or so she thought. And in normal markets, it works beautifully. When equities fall, gold often rises. Bonds stay steady. Liquid funds never blink. Each asset dances to its own rhythm. This is the promise of diversification, and for years, it delivered exactly what the textbooks predicted. Then came February and March 2020. In 4 weeks, Deepa's equities crashed 38%. But here is the real shock. Her gold ETF fell 8%. Her corporate bond fund dropped 12%. Even her liquid fund wobbled. Everything fell together. Her diversification simply evaporated. Why did that happen? Think carefully before you answer. InvestPro arrives with the answer. In a true financial crisis, there is only one trade. Everyone sells everything to raise cash. Equities, gold, bonds, all of it. Correlations between assets spike towards 1. The diversification that protects you in calm markets disappears at the exact moment you need it most. So what actually protects you? Assets that decouple in a panic. First, cash and liquid funds, the most powerful crisis asset of all. Second, sovereign gold bonds, which pay 2.5% interest, and rose sharply after the crash. Third, international equity funds, which gain when the rupee weakens. And fourth, short-duration government bonds. Far safer than corporate debt in a storm. Now meet Arjun. 50 years old, an entrepreneur with a 1 crore portfolio, and he retires in just 3 years. A crisis hits, markets fall 45%, and his portfolio is down 35%. He needs 8 lakhs every single year to live. Waiting sounds brave, selling everything sounds safe. But what should Arjun's plan have been? Choose carefully, his retirement depends on it. The answer is the 3-bucket system. Bucket 1, 20 lakhs in liquid funds. 2 full years of expenses, never invested in risk assets. Bucket 2, 30 lakhs in balanced advantage funds, which rebalance automatically. Bucket 3, 50 lakhs in quality equity, untouched for at least 5 years. When the crisis hits, Arjun draws only from bucket 1. His equities recover, completely undisturbed. Now let us build your buckets. Bucket 1 needs 12.0 lakhs, 2 years of your expenses, parked in a liquid fund. From your remaining 13.0 lakhs, place roughly 40% in balanced advantage funds, and 60% in quality equity for the long term. Design this today, while markets are calm, not during the next crash. Here is the deepest insight of this lesson. A crisis plan built during a crisis is not a plan, it is panic. Your 3 buckets must exist before the storm arrives. And remember, cash is not lazy money. In a crash, cash quietly becomes the most productive asset you own, because it lets you buy wonderful businesses at half price. 3 storm rules to carry with you. 1. In a crisis, correlations spike, and ordinary diversification fails. 2. Build your 3 buckets before the storm. Never during it. 3. Cash and sovereign gold bonds are your true crisis shields. Take the free risk DNA assessment at app.investinsightspro.com. Your crisis readiness score is coming up right now.